Hey there, I'm verified Algo trading champion Kevin Davey, and today I'm going to talk to you about martingale position sizing. Actually, I'm going to talk to you about a little twist on it, and we're going to see what it can do. So let's get started. Okay, so today I'm going to talk to you about what I call a modified martingale strategy. It's sort of like the regular martingale, but with a twist. You start out by betting 1 unit per trade, and if you lose, then you multiply the next bet by this factor Z. Now, standard martingale trading would just be 2. Z would be equal to 2, right? Because you double every time you lose. So the modified martingale, we're going to use something less than that. And we're going to see what happens. And then when you finally win, you go back to 1 unit. So the example down at the bottom, it has a factor of 1.5, so it's not quite a full martingale. So it increases its betting size at a slower rate than you would normally with a traditional martingale. And if you compare the traditional martingale and the modified, just one example here, you can see if the trades are the same. In this particular example, the martingale does better than the modified martingale. But the big benefit of the modified martingale, it doesn't increase size too much, too quickly. It's a slower ramp up in size, which could be very useful depending on your strategy. Here's another example. And in this particular one, all I did was I reversed all the wins and losses of the previous chart, and you can see this time the modified martingale does better. So sometimes one works better than the other. Let's do an in-depth example, and this one is on the Australian dollar Japanese yen pair from July of 2024, and I specifically picked that because there were a lot of martingale traders who were doing this yen carry trade, and it was working great for a long time until July of 2024. And I have a whole other video on it. You can go to my YouTube channel and search for martingale. I think it's called the Martingale Debacle of July 2024. But really what it was were people were buying this uptrend and just kept buying and taking little bites. Well, that works great until the market goes against you. And in this case, just trading it the first few months of 2024, the first 6.5 months, it worked great. And if you had started even with a $50,000 account trading one lot and then using standard martingale, it worked great until July 19th through the 25th. And that's where this kind of approach just fell apart. And basically, almost everybody was trading it. If they kept going with the martingale, they blew out. So I said, well, hey, maybe just use a modified martingale. Let's see what that looks like. And that's what I'm going to do here. So first, just as a baseline, if you just traded one lot all the time, so no martingale, no modified martingale, no nothing, no special position sizing, just one lot all the time, you would have ended up pretty well over the course of that year. The first 6, 7, 8 months of the year. But you would have had a nice drawdown from the peak this was mid-July. You might say, hey, that's fine. I could handle a 9K max upswing, even with a 3K drawdown from here to about here, if I could end up with about 7,000 profit in the end. That's trading one lot. Well, what about if we were to do a modified martingale? So remember, factor 2 is just your standard martingale that I showed you before, and you can see that one just collapses. But if you only used a 1.75 factor on the modified martingale, you end up better. Less profit, max profit, less drawdown, less loss at the end. And then I went even further, tried a 1.5 factor, a 1.25 factor. Things keep getting better. But even with the 1.25, you still it collapsed. And if you could survive that, and even it going negative for a while, you could end up with a little bit of money. But in this case, it would have been better just to trade one contract the whole time. So the conclusion here, at least with this strategy, is we already know the standard martingale didn't work. Well, the modified martingale didn't really help you. And that's the tricky part about using martingale, anti-martingale, modified martingale, any position sizing approach. You're going to find times when it works really well, but then there's also going to be strategies where it really hurts you. So you have to be careful with position sizing. There is no holy grail of position sizing where this particular technique will always improve your results. I've never seen it. And in fact, a lot of them, depending on the strategy, actually decrease your results. So keep that in mind as you look to position size. So my conclusion here, hey, the modified martingale, there could be times it works, but it's not a panacea where it's going to work all the time. What do you think? What position sizing do you use? Send me a comment. Send me an email. However you want to get in touch with me, let me know what you use. I'd love to hear it. I'm Champion Trader Kevin Davey. Have a great day.